Well, good morning or good afternoon, wherever you are around Australia, and welcome to this Grant Thornton Federal Budget Summary for 2020. Today being the 7th of October, it's actually my birthday, although I've got to say, as I woke up, I felt that there were millions of Australians also getting little presents being delivered, so I'm happy to share on the way through. Over the years, we've run a number of these sessions around Australia, and they tend to be face-to-face, so we're really embracing the virtual world here today. And in those sessions, we've often complained how mid-sized businesses missed out or been forgotten child wedged in between small business and big business. But this is very much a budget we see that is pro-business, pro-growth and pro-investment. And we're going to unpick that today and how that might work. But clearly there was something for everyone, but the real fortune is going to favour the brave, those who are both willing and able to invest, reimagine their business and plan and devise a strategy to maximise the benefits from these budgets, and we'll touch on the detail around that. Today, joining me, we're going to cram it into an hour. We've got political insights, economic insights, data, tax, the whole works. And it's a virtual meeting, so we're coming from Canberra, Sydney, Adelaide, and of course, regional Victoria. So for the political insights, joining me will be Hugh Williamson, the National Affairs Editor of Network 10. The economic insights will be Bessa Dita, who is the Chief Economist from St George Bank. And for tax, we've got our very own GT resident technical guru, Yan Wong, who's also one of my fellow partners. This is a 3-day, 7-presentation conference. So we're breaking the mold and we're embracing this whole virtual world and allowing ourselves to bring a whole host of presentations which you are actually in control of, and you can choose what it is that you want to attend. And I'm betting there's a lot more interest this year than what there has been in the past, because there's some great topics coming through. So today there'll be other sessions following on innovation, incentives in industry, supporting businesses through the recession. Tomorrow we're going to be looking at growth and where the investors are putting their bets. We're going to be looking at the social expectations of mid-sized business, which has a lot to do with the COVID aspects and the responsibility of business owners in the COVID environment. And then on Friday, we're going to be looking at cyber security and technology, all of which featured in this budget. So from a housekeeping perspective, you'll see that today there is a little box on the right-hand side where you can type in your questions. And we want this to be interactive. And so please join us, type in your questions, and we'll look to get to them today. And of course, if we can't, we'll look to respond to them afterwards. So without any further ado, with so much to talk about today, I'm going to hand over to Hugh. Welcome, Hugh.
Thank you very much, Greg, and welcome everybody. This is a huge budget last night. Probably as even some seasoned old political hacks up here on the Hill in Parliament were saying last night they don't expect to see or cover another one like this in the course of their lifetimes, or possibly for several. So what we see in this budget is a nation being presented to us that is smaller in population terms than we expected that it would be, a good deal poorer than we expected it would be. The Reserve Bank had its meeting yesterday. As we know, it left interest rates on hold, so there's going to be no cavalry riding over the hill from the RBA to save things. This is going to be a matter of fiscal stimulus to try to get us out of this hole, and that is what this budget has been all about. And it is digging deep. Let's make no mistake about that. There are temporary based, and this is an important word we'll talk about a lot. The incentives, broadly speaking, are designed to be temporary, to try to stimulate the economy and get us back on our feet. This includes some major changes in tax treatments for business. We'll talk about that with Yan a little later on. There's also the JobMaker hiring credit, which will affect business. The government has huge hopes that this will be a big driver of employment. They're looking at it supporting 450,000 jobs out of just one initiative. We'll talk about that a little bit during the course of the next hour. It seems a little optimistic to me. And of course, there are those personal income tax cuts, $17.8 billion going out, including $12.5 billion in this financial year. That is heavily stimulatory. The government hopes that this will generate by itself 50,000 jobs and that people will get out and spend it. And that's another assumption. People have been tending to save money much more than they have done previously. If they continue to save it, much of these budget plans fail. If they spend it, they've got a much better chance of succeeding. As always, budgets are built on assumptions. They're often heroic assumptions, particularly in the out years in budgets. These ones by the Treasurer's own concession. This budget contains more economic uncertainties built into it than we've probably seen since the Great Depression or in modern times, post-war terms, certainly. One of them is that the vaccine will come and be generally available across Australia by the end of 2021. The growth will bounce back to 4.75% in the next financial year. That date's important, of course. We've got a federal election that could fall anywhere from 12 months from now, towards the end of next year or into the following year. Unemployment, according to these estimates, will peak at 8% in the December quarter of this year. That's lower than the 10% that they previously forecast. And perhaps a seriously heroic assumption that unemployment will have dropped back down again to pre-COVID levels, 5.5% by 2023-24. You know, all these assumptions in the out years, you come with a grain of salt. The Treasurer says the nation, it's a simple proposition, the nation cannot recover, he says, unless people are in jobs. And if you look at it through this prism, everything in the budget is pretty simply explicable. It is about jobs. He said it so many times, it's about jobs, but it really is about jobs. And it's because the generation of jobs is what's going to get the economy back on its feet. It has an important total political imperative for this government. When they go into that election, they're going to make the calculation that voters will tolerate levels of debt and deficit we have never seen before if they're feeling comfortable and secure, safe in their homes, safe in their work. If they don't feel secure in their jobs, if that sense of insecurity is deep and by that stage ingrained politically, and politicians always think politically, in terms of elections, this will be a very dangerous place for the coalition to be. They need this to work to drive jobs for their own jobs, quite apart from the nation's survival. So the plan is a total job creation target of 1 million jobs. Bear in mind, 3.5 million people are still on JobKeeper until the end of March. At the end of March, on the current policies, that ends. 3.5 million people. That's a lot of uptake that has to happen. And so what is being baked in, well, not built into this, is huge stimulus for business, but temporary. And this happens for business, but also for state governments. They've got infrastructure funding, but it's a use it or lose it. You must come up with a plan or you lose it. Get out there, spend the money, get the projects. With business, with $32 billion in the full expensing, temporary full expensing, the tax loss carrybacks, it's use it, particularly those full expensing write-offs, use it because they are temporary. They want that money out there and they want that to drive investment and again, drive jobs. We're going to talk about a lot of things. I think it's important to have someone far more expert than I am to talk about the economics of it, the assumptions and the possibilities, how realistic it all is. And so, as we have done previously, we're lucky to have Bessa Dieter with us from the St. George Bank, Chief Economist. Bessa, over to you.
Thanks so much, Hugh. Thank you for having me. I definitely agree. The federal budget this year is really a budget for our time. If we turn to the next slide, please. It shows the chart. The chart really highlights just how big the deficit has grown. We're now forecasting, or rather the government's forecasting, a record-sized deficit of nearly $214 billion for 2020-2021, and that's reflecting the budget of our time. It is without a doubt that COVID-19 is the largest hit on our economy in 90 years, and to do nothing or to do very little risks leaving future generations with a severely degraded economy and lower living standards. So the expansion in the federal budget deficit is certainly consistent with the narrative of trying to get through these challenging times. The key theme being to fill the hole in demand ripped out by COVID-19 pandemic. We've got tax relief for businesses, tax cuts for households, as well as support for those employers hard hit by government-imposed restrictions, and that includes the job maker, the job trainer, and also the wage subsidy scheme for apprentices and trainees. There is a deep awareness throughout the federal budget delivered last night that businesses create jobs, and creating more jobs is the best way to limit the scarring in the economy from the shock of this pandemic. On the next slide, we outline the tax relief that is being provided to businesses and households. So, as I said, a core theme was creating jobs and through tax relief for both businesses and households. For businesses, the two key initiatives are the instant asset write-off provisions and the introduction of loss carryback tax provisions. As Hugh mentioned, these are temporary in nature. It does require businesses to spend for some of these initiatives. For households, we see the personal income tax cuts being brought forward by 2 years and also the backdating to 1 July 2020. So that's raising the start of the 32.5% and 37% tax breaks. It also increases the low income tax breaks. Now, consumer spending has been very hard hit by this pandemic. In fact, in the June quarter, much of the decline in GDP that we saw, so GDP declined by 7% in the June quarter, 98% of that was due to the decline in consumer spending. So the tax cuts are important in terms of lifting consumer confidence and helping to bolster consumer spending and demand for the goods and services that businesses produce. But it does mean that consumers need to spend a lot of those tax cuts, and the danger is that much of that could be saved. In the same thread, for the business initiatives, it requires businesses to spend. Now, businesses face considerable uncertainty. There's no viable global vaccine that is yet available. And in very uncertain times, businesses may be reluctant to spend, particularly in an environment where some businesses are still facing challenging conditions and are preserving cash flow and building cash flow buffers. So in order for those two key initiatives of providing more money to households and tax relief to businesses to work, you do need businesses to spend and also consumers to spend. Now, infrastructure spending continued to be a key theme, and as Hugh mentioned, there were a number of shovel-ready projects announced, as well as the you use it or lose it theme for states and territory governments. There's also job creation initiatives that were announced through JobMaker, Job Trainer and the Apprentice Wage Subsidy Scheme, which I've mentioned. The table just outlines the tax relief that is provided to households through the bringing forward of the personal income tax stage 2, but I will leave it to the session on tax for greater detail. If we turn to the next slide. It's a bit of a busy table, but it outlines what the key forecasts are from the federal budget last night. And I guess one of the key standouts for me is that the economic recovery story, particularly once we get to 2021 and 2022 and beyond, is pretty ambitious. We have a contraction built in for 2020 to 2021 of 1.5% by the government. That is pretty reasonable and very close to our own forecasts. But then in the subsequent financial year, growth is expected to rise by 4.75%. Yet in that same financial year, population growth falls to just 0.2%, which is the slowest in a century. It's a very, very low rate of population growth. In the last 3 years, population growth has tended to average around 1.6%. When we look at long-term economic growth prospects, there's 3 Ps that are important. There's productivity, there's participation in the labour force, and there's population growth. So that seems like a very ambitious target, given that population growth will be very small. Immigration has yet to resume, and international borders, how fully they recover in time is also very questionable, and also in an environment where there still is yet no globally viable, available vaccine, which means uncertainty to the outlook is still very high. The unemployment rate is also expected to decline quite rapidly over the out years. You can see that by the very out period, you've got the unemployment rate actually falling towards 5.5%. Now, the federal government reduced the peak in the unemployment rate from 10% to 8% by the end of this year. That's in line with our forecast that we've had for some time, but we anticipate that the peak in the unemployment rate won't be hit late this year, it'll be hit earlier next year, and that the unemployment rate will remain elevated above 7% for longer. So we're a little bit more pessimistic around the labour market. We think it will take time to bring the unemployment rate back down, and that's also reflected in our growth forecasts. I guess another key factor for the jobs market that is worth keeping in mind is, even though we've got these job maker initiatives, we've got these job trainer initiatives, and we've got these wage subsidy schemes for apprentices and trainees, which are very positive developments, and also target the younger part of the population, which has been hit very hard by the pandemic, we've still got JobKeeper expiring at the end of March next year. And JobKeeper has certainly been the really big game changer as far as limiting the rise in the unemployment rate through the shock of the pandemic on the economy. So I still think there's some potential for disruption when JobKeeper ends, and that for some businesses they'll find it challenging to get through that period of when JobKeeper is due to end. On the next slide, I've just got to show my disclaimer to keep my compliance people happy, and I'd then like to pass back to Hugh.
Okay, I think everyone's had a chance here to read the disclaimer in full, and thank you, Bessa. Tax obviously lies at the heart of the government's hopes for stimulation to go through, particularly through business, and it is expecting business to drive their goals. So let's, without further ado, go to Yan Wong, tax partner with Grant Thornton. Over to you, Yan.
Thank you, Hugh. I think I've got 5 minutes, so what I'll do is just point out my views that what was announced in the budget, and certainly the broader package of coronavirus measures by the government, are necessary, they're fair, and they also give some cause for optimism. And also, Bessa's given a very good macroeconomic view of why we needed them. Allow me to present to you the coalface view as a tax advisor, advising actual businesses and people. I say they're necessary because when coronavirus hit, a lot of businesses were shut down. You've seen the numbers, 103 billion revised on JobKeeper stages 1 and 2 to 3.5 million people, 900,000 businesses. Now, I can't claim to have advised every single one of those 900,000 businesses, Hugh, but I certainly did a lot of them. And I can tell you there was a severe sense of depression, not depression, but certainly pessimism at the time. And what JobKeeper did was provide a necessary bridge, necessary cash to help people look forward to basically look to a time when this coronavirus quarantining and the virus itself might possibly end, and hang on in business, keep people on the books, and keep people productively employed. And that you can never underestimate. You can look at the macro numbers, but the human stories behind those 900,000 businesses was very compelling and very necessary. In terms of fairness, before the budget, there was a lot of commentary about how tax cuts to the wealthy, as some people put it, were unfair, unnecessary, etc. In particular, I remember one interview, won't mention names, but the politician involved compared these cuts. He called it basically the Clive Palmer tax cuts and the Gina Rinehart tax cuts. Nothing could be further from the truth, Hugh. These tax cuts impact people from as low as $40,000 of income right up to the 120,000. Of course, those above that threshold will also benefit, but the benefit caps out at $2,500 above $120,000. Now, I challenge you to find too many people in this country who will say that if you're earning over $100,000, you're necessarily Gina or you're necessarily Clive. Absolutely not. If you look at the numbers, the ATO has identified approximately, well, Treasury, I should say, 4.1 million people who will benefit from tax cuts at the 40,000 to 90,000 range, and a further, let's say, 1.3 odd million above that. These are fair. These are aspirational. query whether the $18 billion could have gone anywhere else in terms of the impact on employment, etc. But I would not detract from the position that I believe that they were fair. Also, the investment allowance. The government's looking at spending about $27 billion, taking the caps off the instant asset write-off. Now, this goes till 2022, so as Bessa said, and I think you made the point, Hugh, there's an element of use it or lose it in all of this. But what that does, a $27 billion tax cut, if you look at the average corporate rate of 30%, translates to close to 100 billion plus of spend. So this is new equipment, or some are second-hand equipment. Some businesses with the under 50 billion threshold can certainly write second-hand equipment off. So that's a lot of new kit. That's also long-term in the sense that it will hopefully improve productivity. It will employ people who sell the machines, who maintain the machines, who use the machines. So yes, it's $27 billion, but I think time will hopefully show that that's $27 billion well spent. And certainly there's precedence. They didn't just make this up. Back in the 90s, we had a 10% investment allowance. And again, when the GFC hit in the late 2010, well, the noughties, as they say, they also introduced an immediate instant asset write-off. So it's not unprecedented. Finally, optimism. We've been here before. I mean, it's very easy to look at the numbers and go, geez, how are we going to ever repay this $1 trillion debt? And that's $1 trillion by 2024. In 1991, I came to this country. I remember studying, and in Sydney at the time, there was a big hole where World Square currently is. Everything was boarded up. In Melbourne, I had family in Melbourne, so I came for holidays. And if you walked out of Flinders Street, you had Young and Jackson across the street. But around it was basically up Swanston Street, down Flinders Street. Everything was boarded up, $2 shops, people on the streets. I thought to myself, why on earth am I here and how are we going to get out of this? And you know what? We did. We didn't do it by raising taxes. We did it by tax cuts. We didn't do it by pessimism. We did it by optimism. So therefore, to conclude, I think the budget as a whole and JobKeeper, the measures are necessary, they're fair, and they give grounds for optimism. Back to you, Hugh.
Okay, Jan, thank you very much for that. It's, as FDR said all that 90 odd years ago, nothing to fear but fear itself, so get out and do it. We'll take your questions if you want to put them into the chat areas there. We'll do our best with that. But I might just start off with a series of questions, if I may, to our panelists. And Greg, if I can start with you, you've just heard from Jan. Jan sort of talked about these in terms of tax cuts, effectively tax cuts for a period of time, but you've got to earn these tax cuts. You don't just get them by sitting around as a normal corporate tax cut. It is, you have to get them by investing. Do you get the sense that the mood is there, that the confidence is there for people to take advantage of what are temporary short-term advantages to business?
Yeah, look, Hugh, I think there's, I know the Treasurer talked about a two-speed economy for those in Victoria and those who are outside of Victoria, but I think there's also a two-speed economy for those that have been heavily hit by COVID and those who haven't. So if you're in hospitality and tourism, entertainment, you may not have the appetite to go and invest right at the moment. But for many others, they still retain a really strong business, and particularly for those that are in states not as heavily impacted by closures and lockdowns, I think there's a great opportunity for people to reimagine their business. And in this instance, and you can see on the slide below, there is a host of opportunities there for people to take advantage of. Now, if you don't step into this and actually innovate, grow, and invest, then these benefits will pass you by. And you won't actually get the benefit of them. So sure, the tax breaks you receive, but if you want to get the instant write-off, you've got to spend. And I think that that's the opportunity for people to sit back and devise a strategy now on how they're going to change their business to ensure that they can take advantage of what might be a once-in-a-lifetime opportunity.
Bessa, Greg just mentioned Victoria there. The assumptions that are built into this budget, one of them is critical to the whole thinking, and that is that we don't enter another wave of infections. And the Treasurer was quite clear about that, that if we have another significant fresh wave of infections, you could add another $50+ billion to the deficits this year, in the coming financial year. The counter side to that is that if the vaccine comes forward and is available by the middle of the year, then that would add $30+ billion to our current state. How critical is it going to be for everyone engaged in this that our management of the virus remains sound?
Hugh, it's absolutely critical. Confidence is critical to the economic recovery, and confidence, first and foremost, of suppressing the virus effectively is what's required for businesses and households to feel confident about the economic recovery. Both yourself and Greg and myself spoke about how necessary it is for businesses to spend in order to access this tax relief, and also how important it is for households to spend from the extra money that's now going to be in their pockets from these tax cuts to personal income tax cuts. Now, in order for that spending to happen, businesses and consumers need to feel more confident. So it's absolutely critical that businesses and households feel more confident about the health situation and thereby also the economic situation. Now, without a viable and global vaccine available, uncertainty will remain elevated. And that means there's always the risk of a very uneven and fragile economic recovery.
So we've seen so much this is human nature and the way in which is almost a kind of a crowd response. One of the things that we saw was record levels of household savings when this first hit. Everyone just shut up shop fundamentally, even though people were still trying to grasp what the nature of the crisis was. Do you get a sense that we have now taken a more mature view of the coronavirus crisis and its economic impact, that people are starting to move more towards a saving, an opportunity mode, rather than purely a put up the shutters mode? Is that showing up in data?
I think we are starting to see an improvement, Hugh. There's a weekly Roy Morgan Consumer Confidence Survey, and that's actually shown an improvement in consumer confidence now for 5 straight weeks in Australia. And I think that's suggesting that some of the pessimism is waning. However, pessimism is still the overwhelming feeling among consumers because the index still remains below the critical level of 100. What I would also say is during the height of the pandemic, risk aversion really shot up to very high levels, as did the household savings ratio during the June quarter. It rose from around 6% in the March quarter to nearly 20% in the June quarter. I'm not expecting that the household savings ratio will stay up around those levels in the second half of this year, but there's certainly the risk that a good chunk of the tax relief to households might still be saved. Hopefully there's still a good chunk that's also spent, because then that's what gets the economy moving along, and that's really critical to this economic recovery story.
Greg, I think you want to jump in.
Yeah, I did. I just also wanted to mention that, as soon as this kicked back in March, we called our board together and the executive together, and we instinctively drew down cash from the bank. And thank you, Bessa, for your support. And we immediately said, well, how do we make sure we've got, cash is king? And that was what, traditionally got people through recessions. And yet what we've seen, and I've shared this example with you previously, is that in the last 4 months, we have had 2 of our record cash collections. And so there seems to be this generosity of spirit that's taking place in the economy, where people aren't trying to use someone else as a banker. They're prepared to keep the cash flowing and keep other people afloat. And I think that shows a different attitude in past recessions, shows a bit more maturity and a bit more generosity.
So how much does sort of national leadership and a sense of bipartisanship feed into some sort of, we're all in this together, we hear this all the time, that can be simply a rhetorical flourish? But you're saying that, in fact, there is something different psychologically about how we're approaching this particular crisis, Greg.
Yeah, look, I received an email from a lady who delivers catering to our Melbourne office about the first week of after COVID hit, and she asked whether we could pay all of the bills because she was short of cash. And so the first thing that I did was I asked my CFO to find all of our small creditors and just pay them all immediately, because they were, clearly she'd reached out to me, but others would as well. But I think that that's what's happening on a much more broader level. People are actually making sure. Now, of course, interest rates are lower, so the benefit of using people for banking, is different. But I think people do want to make sure people stay afloat, and they are looking for ways to keep others in business.
Yeah, and if I could bring in a tax question to you, there's a lot about the instant write-offs. Can you give us a little bit more on the tax loss carrybacks? People may not have a total grasp of how that works for them. How does it work so that you can be losing money but wind up with a refund from the taxman?
Yeah, so the government's committing or estimating about $6 to $7 billion on this. So it's not, it's $7 billion is a lot of money, but in the context of the broader picture, it's maybe not as much. But the way it works is if you made money and paid taxes up to from 2019 onwards, and you made a loss in the year after that, you are allowed to claim those losses effectively against the taxes you paid in the prior year, and get it back as basically what's called a refundable offset. Now, this again is not new. This was tried back in the just after the GFC. The difference now is that there is no cap. Back then there was a $300,000 refundable tax loss cap. Now it's not really limited, although it only applies to businesses with turnover under $5 billion. So, for example, if I made let's say $1 million profit during the good times in 2019, I would have paid 30% of tax on that, say 300,000. If I then made a loss in 21, I would be allowed to use my 2021 loss, reflect that in my 2021 return as an election, and apply it against the tax I paid in 2019 to get my money back now. So, it's a good idea. It recognizes the fact that people are getting hammered by COVID as we speak, and it reflects a degree of fairness that, okay, look, if you paid tax in 19, we'll give some of that back. Again, 7 billion overall. Yes, it's a number, but in the context of, let's say, 103 billion JobKeeper and 18 billion of personal tax cuts, we think it will affect a smaller number of businesses, but hopefully the right business, small to medium enterprises who are viable in the long run, but who may be struggling for the next couple of years.
Well, certainly it goes, as you say, to all businesses with a turnover of less than $5 billion a year. That's most businesses, 99% according to the Treasurer. So most gets captured by that. So it really goes, Greg, to the question of, you mentioned sometimes mid-sized businesses get squeezed between big and small business. How do you think they've come out of this budget?
Yeah, so I think that this is a very pro, business budget, but it's also pro mid-sized business. And we have been quite vocal over a number of years that we felt mid-sized business has been left out, and there's been caps and collars which have seemed to have left them out of a lot of budgets in the past. But this year they're participating in the loss carryback. With the increase from $10 to $50 million on the small tax breaks, it brings a lot of them into there. There's investment write-offs, job maker, traineeships, R&D, digital technology, obviously the infrastructure, boots and utes, impacts a lot of mid-sized business, and for some of them, modern manufacturing. Mid-sized business can feature in all of those, and we've never really seen that sort of a plethora of opportunity for mid-sized business. So from our perspective, we're absolutely thrilled with that aspect of this budget.
Do you have a sense, and I'll put this to Bessa in just a moment, do you have a sense that there'll be much take-up of the job maker hiring credit? This is aimed at getting younger workers back into jobs. The government will pay $200 a week for new hires of people under the age of 30, so 16 to 29, and then $100 a week for those from 30 to 35 or before their 36th birthday. There are expectations, the Treasurer told me, that would deliver 450,000 new jobs. Do you have a sense that there's this appetite for an incentive that would work like that?
450,000 is certainly an ambitious number, but regrettably, when we do go into a recession, the first thing that people look at is to reduce their discretionary spending, and the second thing they look at is their labour. And so, as employers, many of our clients are sitting there and they have been looking at their labour. What labour force can they reduce down to manage their way through the recession and build back out of this. And what this does, it actually does create an opportunity for people to bring in younger people at a reduced cost, build up their expertise, and have the workforce grow. So I think people do have a desire to have people in the business, and as they grow, they will look to this as an alternative. I wouldn't want to be 37 at this point in time, I've got to say, but I do think there is an incentive there that will be used. 450,000 might be ambitious, but certainly I'm pleased to see that they're encouraging people to get people back in the workforce.
I'd take being 37, Greg, but you go nostalgia reigns. Nostalgia reigns strong.
No, this isn't my 37th birthday.
Yes. Oh well, never mind. They're all anniversaries of the 37th birthday. Besser, what do you make of that? It's because there is so much expectations are weighted on this job maker hiring credit to deliver half of all the jobs that the government claims it's going to have to produce. What are the prospects?
Look, I'd have to say firstly, Hugh, that it's a positive development, particularly given that the pandemic has hit young people really hard. The unemployment rate for the youth is sitting at 13.8%, which is well above the national unemployment rate of 6.8%. So it's a positive development to try and address the youth unemployment levels. However, I would agree with yourself in that the number of new jobs that is aimed to be created out of this job maker scheme is probably very ambitious. So far, the number of net new jobs that have been lost since the pandemic is 414,000 in the couple of months to August. So it does seem like a very ambitious number. However, it's a positive development. So I won't. I'd like to stick with that.
Do you think there's any risk that it could be gamed by by employers of large numbers of younger workers? Without wanting to name anyone, one might think of some fast food chains and so on, who could take advantage of this to get subsidised workers, possibly by putting off workers, bring on other workers, getting a subsidy and getting an entire workforce at a cut rate.
Well, I guess there's always the opportunity for some schemes to be abused, and hopefully that won't be the chunk of how this scheme is used. What I forgot to add, Hugh, in the earlier conversation is that it's not just important in getting the unemployment rate down, it's also important in getting the underemployment rate down. There are people that have jobs at the moment, including younger people, that would like to work more hours than they currently are. So whilst these schemes do help address some of the job creation for the younger people, they don't really also address the issue around working more hours. There is still an underemployment issue that is probably actually an even bigger issue than unemployment at the moment.
So some obvious people who have missed out, obvious areas of the economy that have missed out in this budget. There were some expectations that there might be some similar scheme to the job maker hiring credit that might work for women who have also been affected disproportionately. There might be something in childcare. There was temporary free childcare at one stage. Social housing is another one that comes up, the argument being that it's both stimulatory to the construction industry while also providing a long-term good, and also that Job Seeker New Start could have a raised base rate. None of those things have really come through. Do you have a judgment on that, Besser, as to whether there were any missed opportunities there?
Yes, certainly when you look at the missed opportunities, they are the ones that you've mentioned. Childcare still remains very unaffordable for many people. I have a preschooler, so I can attest to the fact that long daycare is very expensive and unaffordable for many families. As you mentioned, there wasn't much towards social housing. The first home deposit scheme was extended to include an extra 10,000 spaces, but there wasn't anything in that housing social area. Elizabeth Hill from the University of Sydney has done some research that suggests that it actually adds 5 times more jobs than your overall construction initiatives. And also, as you mentioned, Job Seeker scheme wasn't permanently raised. But also, I'd like to flag that the JobKeeper scheme wasn't extended beyond March, and I would have liked to have seen that extended beyond March. I'm not confident that economic activity will be strong enough and sustainable enough for JobKeeper to completely end on March 28 next year. I would have liked to have seen it further wound back and extended in order to minimise some potential disruptions to the job market.
Do you see a risk that come March the 28th, there could be another shock when people do come off? 3.5 million people, it's a lot of workers out there are still dependent on even a reduced JobKeeper. And when they fall off that cliff, if the government lets them fall off on that date, and those are the numbers in the budget, that could provide another big shock to the economy and confidence.
Yes, I'm not sure that we'd see as big a shock as what we've seen in the June quarter. I think that's the biggest shock we'll see to date, provided that there's no further waves of the virus that come through. But I do think that it could provide an acceleration of job losses around that time. It is a big risk to the labour market. As you mentioned, there are a large number of people on the JobKeeper scheme, and if these initiatives to get business spending and household spending isn't enough to bolster economic activity around that time, then it will be challenging for some businesses not to lay off workers. And so I do think next year will be still quite a tricky year for many businesses, and it will be a long, uneven and gradual recovery story for Australia.
Yeah, and if I can ask you a question, if you look at these, whenever there's tax changes, and these are profound tax changes, there's always new elements of complexity for businesses to get their heads around, particularly if they want to take full advantage of it. Looking at this as a suite of measures, do you see them as being particularly complex for businesses to manage, compliance, to make sure that they're taking advantage of understanding them and taking advantage of them properly?
Yeah, I understand. Look, short answer would be no, because as I said, a lot of the measures have been tried before around the investment write-off and the loss carryback. And well, personal tax cuts, just, the tax office will just administer those without any real complexity there. I would say that the one JobKeeper was challenging. I know that's not part of this budget, but as we've heard, it will go until March, and it was $103 billion. That required a lot of people to wrap their minds around that, but you know what, it was a worthwhile exercise. And I think sometimes when you're spending that much money, some complexity comes with the territory, and we just have to get on with it. But this has not been one of those fancy big end of town type anti-avoidance tax reform measures or packages.
I've got some questions that have come through, and I'd like to get to some of those if you're all comfortable to take some. And I might start with you, Jan. Yep. Just confirming, the instant write-off relates to any value of asset purchased if your turnover is under 5 billion.
Yes. So if you meet the conditions, and they're either new or in some cases, if you meet certain turnover secondhand, yes, there is no longer the cap. The 150 cap is gone. Of course, there's a certain reality about, small, medium enterprises not going to go out and buy, a new jet or something. There will be that natural business restriction because people aren't exactly flush with cash at the moment. But no, there is no legislative cap on the dollars spent on the asset.
The assets can't include real estate assets, though, can they?
No, so typically the write-off deals what we call Div 40 plant. So that's your widgets, your plant and equipment, machinery, that sort of stuff.
Okay, another question. They're all good tax questions. How are the backdated tax cuts to be paid? Will the ATO pay them directly to people, or will they go through payroll? This would be the personal income tax cuts.
Yeah, so there's a couple of elements to this. Obviously, to the extent you're in like most employees would be in the PAYG system, we haven't seen the administrative details yet, but because they are backdated, I suspect what will happen is they'll reduce the PAYG rate, so people's take-home pay should be increasing going forward. I don't know necessarily that the ATO will immediately refund them on the spot the balance. I think what might happen is they might adjust or you get it when you lodge your final return. You get a refund of that if you indeed your tax withheld is less greater than your tax payable. But I don't think the employer itself will be handing out cash back, because the employer doesn't have that money. The money's gone to the tax office, and the typical measure for getting that back is through refunds on lodgement of tax return and a reduced PAYG rate.
And for those earning under 90, I think they get that low and middle income tax offset has been extended out. So that's that's $1,080 that they get with their tax return at the end of the financial year. So
correct.
That's valuable for them, and presumably a big cash stimulus into the economy at that time. A question regarding the not-for-profit sector from Philip Petrie. How do the incentives play out for the benefit of the NFP sector, who are essentially not paying tax at most levels?
Yes. So, okay. The short answer is, well, they don't, except for the fact that they did qualify. Well, for those who did qualify for JobKeeper, they would have certainly benefited tremendously from that. And I mean, look, if you're not paying tax, I suppose, it's very hard for a tax break to benefit you.
Yeah, it's fair.
Stating the bleeding obvious, but yeah.
Yes. Okay. Alan Tunney, intriguing question here regarding the JobMaker hiring credit. Is the government expecting business to specifically advertise for an age group for a job and effectively allow a discrimination choice to get the subsidy? I don't know who answers that one, but it does introduce the discriminatory nature. Only apply for this if you're under 35 or under 30. Have you got a thought on that, Greg?
Well, you'd want to tread pretty carefully on that, down that path, but it may well be that you would be entitled to ask people whether or not they would allow you to comply with JobMaker. So, i.e., do you fit that age bracket, and were you on unemployment benefits? I understand. I know you mentioned a question to Betsy earlier on, but I also understand that they do require you to demonstrate that you increased your total spend on payroll and headcount. So you can't just sack people and bring new ones in. It actually has to be an add-on as well. So that will help to deal with some of those issues. But yeah, look, that's new territory for, isn't it? Those sort of questions.
Well, it does raise.
I also wonder, Hugh, if it's targeting those industries that have been hardest hit, like the hospitality industry, the arts and recreation industry, where there is a high share of workers that are in that younger age bracket and that typically work part-time or casual.
I also wonder, with mutual obligation coming back into play, if we're then essentially dooming a whole bunch of over 35-year-old workers who are going off to job ads when they've got no prospect of getting it, because why would you hire that person when you can get someone and get an incentive from the government, a payment from the government? It could be fairly soul destroying for people in that setting. But
what we have seen is that a large number of people have actually dropped out of the labour force. So when they've lost their job, they've actually stopped looking for work. So it means they're not actually in the labour force, so they don't even get counted. And so we've seen this massive drop in the participation rate. Now we're seeing some people return to look for work as the Australian economy has reopened outside of Victoria. And that means then that you do have to have stronger job gains in order to prevent the unemployment rate from rising, because the labour force is actually expanding as people return to look for work.
Another question from Alan, I don't know the answer myself. Is the ATO administering the JobMaker via BAS statements?
I think the ATO, if I remember reading the papers correctly, that ATO has been tasked with the scheme, but how that 200 comes, I think it'll be very similar to the JobKeeper mechanism, i.e. through STP. You'd probably have a box on the single touch payroll form that says, is this employee in the right age group? Whatever the requirements are, and you tick those boxes, then your $200 per week or whatever it is comes back. But look, again, the budget's a high-level document. We'll really need to look at the administration to really figure out how this works.
We haven't mentioned property at all in this conversation. So a question from Rachel Wong. What are your thoughts about the property market, especially for Victoria? The land tax relief from the state government doesn't seem to have been effective so far. Greg, you've got thoughts on that?
That sounds like one for me, Hugh.
Oh, sorry, I'll take it.
No, I'll let Greg go, and then I'll pick up the thread.
No, you go. You lead off.
I was just going to say that nationally, the latest data has showed some signs that the downturn's actually easing in dwelling prices. In Victoria, though, dwelling prices continue to turn down, and that downturn has been accelerating, given that they haven't returned to what you would consider to be stage 2 or stage 2.5 sort of lockdown conditions. Look, we do anticipate that dwelling prices will continue to soften, mostly in the capital cities of Sydney and Melbourne over the rest of this year and next year. And that's largely being driven by the fact that international immigration has stalled, population growth is very limited. You've also got considerable uncertainty and the unemployment rate rising. However, you've still got very low rates of interest. People won't sell their home unless they have to, so that limits the amount of stock that is available to buy, but that also limits the extent of declines in dwelling prices. As I said, also what we're seeing is there is interest from owner-occupiers and also in the regional areas of Australia, where lifestyle is more attractive and the density of the population isn't as great. So the regional areas of Australia are actually showing a lot more resilience than across the capital cities.
Interesting. A question here from Mark Nilsson. Do you think the loss carryback provisions are a way to try to reduce companies doing a phoenix? Greg?
Gosh, I don't necessarily think that, well, okay, maybe I'll let Greg as the insolvency specialist talk to that, but I doubt very much this will encourage anyone to, I mean, if you were of that mindset anyway, I don't think this will stop you doing that, but I don't think businesses are in the business of doing phoenixing, so it'd be a very small number of people that would even contemplate that, I think, Hugh.
Okay.
Yeah, I think, I mean, the loss carryback, really works for businesses that have been successful, strong, paying profits, built on a strong business, and then because of COVID and this, unique change in the environment, they've become, loss making, and so it really does allow them to build that bridge back into being, successful again going forward. I think the change that's really kicked in is the new Chapter 11 provisions that have similar to Chapter 11 provisions that have kicked in there, which I think will get used by businesses smaller than $1 million, particularly in Victoria where they've been closed for such a long period of time. It'll be cheaper, quicker, but most importantly, being data-driven, they'll be able to remain in control. So I suspect that will be attractive. The issue, if I just touch on the real issue for businesses that are going to have solvency issues, they may well do a deal with their creditors, but the liability doesn't go away; it just gets transferred. And so, if you are dealing with businesses that are potentially going to become insolvent and go through some form of transition, you need to be aware that you may end up having to write off the liability. So you still need to be very vigilant to ascertain who you want to trade with during this period.
We've got a question here about superannuation from Greg Wong. It says there's an announcement in relation to superannuation fund performance and implications for both employers and employees. Could you please explain? Thank you. I don't know if anyone read up on that particular thing. It struck me, I'll jump in here as best I can, it struck me there was a lot of interest as to whether there'd be much on superannuation. The key thing is that when you change job, your super will follow with you. That's now going to be written into law. The key thing about fund performance is that you're going to be, or all the superannuation funds are going to have to meet an annual performance test, and if funds fail that test, they'll have to write to inform their members that they have done that and give them the option of moving their money to a better performing fund. So,
oh my goodness.
Yeah, we didn't do well. Here's another fund you might like to try. So obviously the incentive there is to essentially push along the getting rid of, by another means, those underperforming funds that have been out there hanging around. The complaint has been made that there's too much choice, but people aren't making informed choices about how to move into better performing funds with lower fees. And plainly they're on a bit of a warpath about fees. So there's going to be greater transparency and accountability. And one key thing, and this goes to, I guess, those superannuation funds activist instincts, which we've seen come to the fore on a number of issues, including most obviously on climate change. The government is raising the standard for all super funds to ensure they only spend members' retirement savings on activities that are in their best financial interests, so to maximise their retirement savings. And that would seem to be, to put the suggestion, it's Bill Kelty's original suggestion that super funds are only there really to improve your prospect for your retirement income. They're not there to become activists. So I don't know if that answers your question, but that's the best I can offer. We've got time for possibly a couple more. Here's a question from Jennifer Spillane. Is there anything to stop companies laying off older workers and replacing them with more cost-effective younger workers? I'm a woman over 50 who was retrenched twice in 9 months once I turned 50. This is not a story she has all to herself. Greg, do you have thoughts on that?
Well, I think the criteria, as I saw it, once again, it's the early stages, but the criteria I saw said that you need to ensure that you're actually increasing your overall cost of labour and also headcount. So if you are looking to simply replace, then I don't think that that's going to work. Whereas if you're looking to expand, there's obviously an incentive to bring in the younger workforce. But if you're just replacing them, then on face value, that shouldn't reward that behaviour. But having said that, I think it's a risk.
If you look at Jennifer's account, regardless of what was in this budget, she's been retrenched twice since she turned 50 in 9 months. It suggests that there are limited protections. Obviously, we're in a time of retrenchments across the country, but there are limited protections against being laid off for older workers. Do you see that showing up, Bessa, at all?
I can't say that I've spent a lot of time looking at that detail. Certainly, the unemployment rate is higher for the youth and much older workers compared to, say, the middle. But I haven't looked at that particular issue in a lot of detail to comment on it, I think, accurately.
Right. I think we're almost out of time. I'm having a quick check through. Okay, here's one. We might leave on this one from Nick Katoris. If you're looking to hire someone in a different country, will it count under JobMaker? My guess would be no. Nice try, but it's not about stimulating the Australian economy.
Unless they're an Australian resident returning.
Yeah.
But yes, probably not a non-Australian resident.
No, I guess the question, I suppose, implies that you've got a business which crosses borders, and that you're looking to hire someone that maybe you can get an advantage to that. But I think it's about Australian workers. So, Nick, good luck with the hiring, and but I think you might have to pay them.
It's about improving the unemployment rate in Australia, not other countries.
Not in Singapore. Yeah, true enough. No, look, we are out of time. Thank you for all those questions. My apologies to the people who sent questions in. I didn't get time to get around all of them. I hope we had a reasonable sampling there. Some of them were similar, covering similar sort of territory, but we are out of time. If you can thank Bessa Dita, Yan Wong, and of course Greg Keith, and I'm Hugh, and thanks for watching.